In January 2026, the new business volume for equipment financing hit a record $11.6 billion. As this heavy-duty machine powers on, it represents a global market size projected to reach over $1.5 trillion. Today, over 80% of all U.S. businesses rely on this specific financial mechanism to acquire their hardware. If a founder asks a bank for a $50,000 unsecured line of credit, they frequently face a swift rejection. Yet, if that same founder requests $500,000 to purchase heavy machinery on the exact same afternoon, they are often approved. The bank willingly accepts 10 times the financial exposure. This diagram shows a UCC1 lien connecting a bank vault directly to the machinery, which explains the bank's logic. A UCC1 lien is a legal form a creditor files to claim an interest in a debtor's property. By securing the loan directly against the physical asset, the lender isolates their risk purely to the equipment itself. If the borrower defaults, the bank simply repossesses the hardware. They avoid complex legal battles over the company's bank accounts or the founder's personal real estate. That clean recovery path translates to an industry-wide approval rate of nearly 77%. Because the equipment serves as its own collateral, business owners leverage physical assets to bypass the strict underwriting barriers of traditional unsecured loans. When structuring this debt, businesses face an immediate choice. The first option is an equipment finance agreement, or EFA. An EFA is a straightforward loan where you borrow a lump sum to purchase specific equipment. The primary advantage of an EFA, or a $1 buyout lease, is that the business takes title from day one. You make fixed monthly payments and build equity in the asset over a set term until you own it free and clear. The counter strategy is the fair market value, or FMV lease. An FMV lease is an operating lease where the lending company retains ownership and you simply pay for the right to use the equipment for a few years. Medical practices and tech companies frequently use FMV leases for rapidly depreciating assets like diagnostic imaging machines or computer servers. At the end of a 2 or 3 year term, they return the outdated hardware to the lessor. The business intentionally dumps the obsolescence risk back onto the lender. A construction firm buys an excavator with an EFA because it holds value for a decade. An IT firm leases servers because they become obsolete in 36 months. The choice between a loan and an FMV lease relies strictly on the expected lifespan and depreciation rate of the specific asset. This official IRS Section 179 tax document highlights a deduction limit of $2,560,000 for 2026. Section 179 is a tax code provision that allows businesses to deduct the full purchase price of qualifying equipment in the year it is placed in service, rather than depreciating the cost slowly over multiple years. Section 179 has a specific limitation. It cannot create a net operating loss. A net operating loss occurs when a company's allowable tax deductions exceeds its taxable income. To bypass this cap, businesses utilize bonus depreciation. With the recent permanent restoration of 100% bonus depreciation, the dollar cap is removed entirely. Businesses can now deduct the total cost of new or used equipment and actively create a net operating loss, strategically offsetting other profitable income streams. These deductions require ownership. Section 179 and bonus depreciation apply exclusively to equipment loans and capital leases. If you sign an FMV operating lease, you do not own the equipment and you forfeit these tax codes entirely. By utilizing equipment loans to trigger immediate write-offs, companies effectively convert their operational profits into tax-deductible physical assets. This side-by-side data comparison reveals why founders with flawless personal credit still get mysteriously denied. A strong consumer FICO 8 score of 700 often coexists with a failing Equifax business score of 530. Equipment lenders regularly ignore your personal FICO score during underwriting. As the Equifax side breaks down into a timeline, you can see an empty SBFE data feed. The SBFE, or Small Business Financial Exchange, is a data repository where lenders share business payment histories. Equifax heavily punishes thin commercial credit files that lack SBFE trade data, regardless of how much personal wealth the founder holds. Securing an equipment loan directly populates that empty commercial file. Paying it on time establishes true institutional business credit, eventually removing the need for the founder to sign a personal guarantee. The massive volume of this industry attracts predatory actors. The most common trap they deploy is factor rate pricing. A factor rate is a simple decimal figure used to calculate the total cost of funding, but it is entirely different from an annual percentage rate. Watch this mathematical conversion. A lender might quote a low-sounding 1.35 factor rate on an 18-month term. When you run the actual math on those payments over time, that innocent decimal disguises an effective APR of well over 35%. Another trap is the evergreen clause. Many lease contracts require written non-renewal notice within a strict 90-day window before the term ends. If you miss that window by a single day, the contract auto-renews, forcing you to pay thousands of dollars in extended lease payments on equipment you have already fully paid off. Predatory lenders also file blanket UCC-1 liens. Instead of securing their interest solely against the single machine you purchased, they file a lien covering all of your business assets. This completely paralyzes your ability to secure future lines of credit from other banks. If a business owner signs a contract with a disguised factor rate, an evergreen clause, and a blanket lien, the leverage reverses. The founder becomes a trapped yield-generating asset for the lender. In a company's capital stack, equipment financing is the foundational layer for institutional leverage. As the diagram builds upward, the impact becomes clear. A secured installment trade line provides the data points banks require, building the FICO SBSS score needed for multi-million-dollar SBA loans. While the machine is the immediate acquisition, the long-term result of this strategy is a self-sustaining commercial credit profile, securing permanent access to institutional capital.